You are listening to the Marc Guzman podcast experience.
Okay, so the next topic we want to talk about is the Fed rate, and is the Fed going to cut rates or are they going to increase rates? We saw them increase toward the end of 2018. We saw the devastating effects from that. We saw a big slowdown in many different sectors. Many corporations, one of the big problems is that corporations cannot afford the increase in interest rates and short-term rate because of the debt that they owe. So
just to put things in perspective, when they cut this particular Fed rate, it doesn't just affect the housing market with respect to interest rates on mortgages. It also affects employers. Many of them are relying on lines of credit to make the payroll because of accounts receivables coming in. So the manufacturing industry that employs many individuals, or the retail industry, are all going to be affected by these increases or decreases in the Fed rate. And of course, if a company can't afford to make payroll, then it's going to lay off hundreds, potentially thousands of employees.
And the one big scary thing in the tech sector is a lot of the different zombie companies, where as little changes to the simple short-term rate increases so much in interest payments on their debt that they owe, that it just causes a lot of problems. If we have a recession and a lot of these zombie companies, the reason why they're called zombie companies is because their income, their revenue does not cover expenses. And if they can't raise capital, well, guess what? They're going to have to do massive layoffs to bring the numbers to balance them out, or they simply just go out of business. And that's the scary part about the next recession, is that you might see a lot of job losses instead of a housing market crash like many people are thinking. But a lot of people say, okay, well, the Fed, are they going to raise rates? No, they've already announced they're not going to raise rates. We've seen the damage done with just a little bit of increases. But how does this affect the actual long-term 30-year mortgage? Because we saw the 30-year mortgage drop yesterday.
Right. Well, again, when the 30-year mortgage drops, it of course makes the cost of borrowing money cheaper. It allows more people to buy homes. The people who are employed by large employers, they're able to keep their job and afford the mortgage payments, right? So,
and one thing that you also mentioned to me a while back, and you pointed this out to me about a year or two ago, is that the long-term rate also tends to follow the stock market. And if you notice what's happened with the stock market this week, we've had a lot of turmoil. We've had the stock market drop a bit because of the whole China-U.S. trade war, where they're trying to. Trump basically gave an ultimatum on Twitter, of all places, and there's a lot of uncertainty going on. And now they have a deadline for Friday to really come up with some kind of trade agreement. And so, because of that turmoil, you see the stock market drop. Yeah. And coincidentally, the 30-year mortgage rate dropped.
Correct. Well, you got to remember too, with the trade war in China, that most of the companies that are actually affected there are going to be American companies that have decided to manufacture products abroad because of the better job wages, or the lower cost of job wages from a manufacturer standpoint, which are in turn imported back to the United States. So these additional tariffs are causing it to be more expensive to import certain products that are traditionally American companies like GE that manufactures a lot of their things in China. And so all of these different things are kind of, we're now in an environment where, even though we might be separate countries, we're all extremely intertwined, at least with respect to China, where if whatever affects us here is affecting China in some way, and vice versa. And so all of these different things right now with the trade wars are also causing this turmoil that you've described, that's affecting the stock market and also affecting the economy, to the extent where the Feds, they realize if they increase the Fed rate, which they should do, will essentially turn us into another recessionary period. So of course they can't do that. So there's a bit of a gridlock going on.
Yeah, it's very interesting to see what's going on between China and the U.S. And a lot of this trade war issue going on is really because China has caught up to the U.S. in the market share of the global economy.
Correct.
In fact, I've got a great chart here, and I can't really show it to you right now, but we'll show it later. But basically, it covers a 1,000-year view of the global economy and basically the powerhouse countries. And you had India and China 1,000 years ago as the powerhouses of the world economy. However, that greatly changed, and then it quickly became Europe, and it became the U.S. However, China's caught back up, and now there's a big battle between the two in order to stay as a number one superpower, because as you know, when you're at the top, that's when you get the investments, that's when your economy grows, and that's when your people become prosperous. So it's crucial for the US to stay on top, but it's becoming harder because, again, we're intertwined. It's a global economy, and it's not as simple now as just adding tariffs.
Right. No, absolutely not.
Okay, so next topic, we want